$67 billion. That's what IBM lost in a single day. The worst day in its 115-year history. The trigger was a 42% collapse in one hardware line, but the segment that line sits in fell just 7%. But there actually is another number that would mean real trouble for IBM, and it wasn't in a single headline this week. The one line that crashed is IBM SET, the mainframe servers that run transaction processing for banks, insurers, and retailers. These servers are part of their infrastructure segment that generates roughly 3 to 4 billion in revenue in a typical quarter. The broader infrastructure segment, which includes these mainframe servers, was down only 7%. And just for context, in the last quarter, IBM made 7 billion in revenues overall. So it's a significant part, but not the full story. And the overall revenue did even increase by around 7.5% from the last quarter and by 1% year over year. So the market took a number that describes only part of the business and used it to reprice the whole company. But that number alone doesn't mean much until you understand how IBM actually makes their profit. Because the majority of the profit doesn't come from selling metal boxes. It comes from their high-margin software. This is the financial bedrock of the company that generated 7.8 billion in revenue. So more than double that of the infrastructure business. And the software segment is also the margin driver of the company. When we dig into the latest 10Q report, we see that the software segment is not only the one with the highest revenue, but also the one with by far the highest margins. 82.6% against the 58.4% in the infrastructure segment. So the stock didn't crash because the market cares about hardware. It crashed because the market is afraid that the software revenue, of which a large part is recurring revenue, could also start to break. But mainframe hardware is highly cyclical, and IBM's management has said that a slowdown like this has happened before. So let's check. Has it ever looked like this and come back? I pulled the numbers for the last 4 generational troughs, and yes, it has. And the numbers are actually pretty close to today. In 2016, IBM went through the Z13 trough where the hardware revenue declined by 41% year over year. With Z14, it declined 41.8%. So we have 2 prior generations that both cratered in the low 40s. Almost exactly the same picture that we see today. Now, there is one caveat to this. IBM spun off Kyndryl in late 2021 and reorganized the whole infrastructure segment. So the 2 oldest data points weren't measured on quite the same basis as the 2 most recent. Still, roughly comparable, but not quite apples to apples. But on size alone, this isn't a historic collapse. It's the mainframe business doing what it always does between generations. Customers stop buying the old box once the new one is close, revenue falls off a cliff, then snaps back as soon as the next generation is launched. So even though it looks tough at first glance, it's not a new low, and it's not proof that anything structural is broken. Now, there is one number in this cycle that doesn't match the other 3, because every prior trough hit 6 to 8 quarters after the previous generation was launched. The current one already hit at quarter 4. So the current cycle is only half as long as usual. But that gap isn't really about mainframes. Because IBM's enterprise customers are the same companies that are racing to lock in AI hardware, if possible before the next price increase. And the mainframe license renewals are getting pushed back to use the budget otherwise. So the cycle alibi is true, and IBM's CEO gave the proof that the mainframes are only delayed, not cancelled, straight in the earnings call. Here he said that 1/3 of those deals have already closed in the first 3 weeks of the 3rd quarter, and that they expect another 1/3 to close in the second half of the fiscal year. So the hardware drop wasn't caused by customers abandoning IBM. It was a timing anomaly driven by a short-term capex shuffle to buy more AI chips. But it opens the core question that actually decides if IBM's stock is a buy. if clients temporarily delayed software contracts to buy GPUs. Is the underlying mainframe base still healthy? Or is the software annuity already starting to decline? Well, in Q2, the transaction processing software dropped 9% year over year. That's nowhere near the 42% crash in hardware. But the overall software segment still grew by 5%. So the high margin segment is decelerating, but it isn't collapsing. And yes, a 9% dip does look concerning on paper. But it's directly tied to those multi-year license agreements that were delayed. With this delay, the license fees are also pushed to the next quarter together with the mainframe revenue. But the real test whether the software revenue is declining comes down to one metric: compute capacity, or the installed base of their mainframes. Because if customers were actually migrating away from IBM's mainframes, the total installed capacity on the platform would be shrinking and the software would eventually leave with them, cycle or no cycle. IBM itself says that the installed capacity is now over 140 million MIPS, with 85% of that base either holding steady or even expanding. Of course, that's IBM themselves telling us how well the product does. So treat it as a claim rather than a fact. But the BMC mainframe survey polls the people who actually run these systems independently every year. The 2025 edition found that 72% of organizations are increasing mainframe capacity, not shrinking it. And the same survey has another number that kills a whole separate bear argument on its own. Namely, who is running these systems? In 2018, 37% of the mainframe workforce was millennial or Gen Z. By 2025, that flipped to 66%. The story that mainframes are dying has been told for 15 years already. But that's not true when we look at the development of the workforce. The reason why none of these customers pack up and leave over one bad hardware quarter is the reliability of IBM's systems. IBM SET has posted the industry highest server reliability score for 16 years in a row. And when your core transaction system hasn't gone down in any measurable sense in over a decade, you don't migrate off it because a product cycle ran a bit short. You don't migrate off it at all unless something actually breaks. And so far, nothing has. We can also see this strong position in their margins. The gross margin, operating margin, and return on invested capital are all growing since 2022. Gross margin by 4%, operating margin by 14%, and ROIC by almost 7%. The gross and operating margin are even at the highest level of the last 10 years now. So the bare thesis that IBM's mainframe business is dying doesn't survive the evidence. The software revenue isn't breaking, the installed base is still growing, and the reliability mode is also still standing. But that's only the mainframe half of this story. And while everyone was focusing on this 42% drop, another piece of the company was quietly boosting the best quarter in its history. And nobody put that number in a headline either. But before we go there, if you like this kind of video and think that it helps your own investing, hit subscribe. I post up to 2 of these deep dive videos every week where I focus on the fundamentals and not the hype. Now, the business part that did grow is distributed infrastructure. That's power servers, storage, and the other non-mainframe hardware businesses, and it just posted the best quarter in IBM's history, with the revenue up by 37% year over year and 500 million in backlog still to ship. And it's not a coincidence that this is up while mainframes are down. It's essentially the other side of the same trade. Gartner's 2026 forecast has global IT spending hitting $6.15 trillion this year, with server spending alone up 36.9% year over year. That's the fastest growth of any category. And almost all of it is chasing AI-capable infrastructure. So when IBM's management says that the AI-driven budget reallocation is the reason mainframe orders got delayed, it's a real industry-wide capital shift, and IBM's own numbers show it pulling money towards power and storage rather than away from IBM entirely. But this raises the next question. If the recurring software revenue is still intact and the segment growing, why did the stock just lose a quarter of its value? Well, that's a pricing question, not a business question. Because right before the crash, IBM was trading at 21 times price to free cash flow, and earlier this year even 24 times. That's the highest valuation in 2 decades. After the crash, it's sitting at 15.5 times right now, which is still around 2% higher than the average valuation of the last 5 years, and even higher when we look at the average of the last 10 years. The PE and the EV to EBITDA multiples have also essentially come back to the average values of the last 5 years. So the stock didn't get cheap. It just got back to normal. But not cheap isn't the same as not worth owning. And one comparison shows this much better than the multiple does. The free cash flow margin. IBM's free cash flow margin is at almost 18%, while Accenture's sits at 15.6%. So IBM is out-converting revenue into cash while still carrying the capital-heavy hardware business that Accenture doesn't have to fund at all. And then we also have a price floor under all of this. The 3.3% dividend yield that is well covered by the free cash flow and was raised for 31 years straight. Through the dot-com crash, the 2008 financial crisis, and the Kyndryl spin-off. Overall, IBM gets a score of 5.4 and 5.9 out of 10 in my quant rating system. They have pretty good scores in health and profitability, dividend, and quality, but the value and momentum score is dragging the overall score down. The growth score is also rather mediocre, but mostly because of the low 10-year growth rates. The EPS and revenue forecast for the next 3 years is in the mid-single digits, so not too bad. When we run IBM through my 2-stage discounted cash flow model, it essentially confirms this. With a WACC of 7.6% and a short-term growth rate of 5.5%, I come to a fair value of $209.66 without a margin of safety. That's even below the current stock price of $229.30. So my discounted cash flow model also pretty much says fair value, maybe even a bit on the rich side. And here is the check that matters more than the model itself. If we run the discounted cash flow backwards and start from today's price and solve for the growth rate the market is assuming to justify the price, the growth comes out at 7.5%. Compare that to the 5.5% that I assumed for the next 4 years and which is actually also the analyst consensus. The implied growth rate is currently 2% above that. So the market isn't pricing in a huge growth, but there is also not much room for error at today's price. And even if we would increase the terminal growth rate to 2.5% instead of the 2% that I assumed, the fair value would actually still sit pretty close to the price today. So my buy price, including a margin of safety, would sit at around $190. So the base case says fair price, not cheap. The 21 analysts that give a 1-year price target are a little bit more bullish, but they also only see a 7.8% upside for the stock. And when we consider that analysts are usually rather bullish, the difference here is not very big. So IBM is not a trap, but not a bargain either. That's what both the relative and the absolute valuation tell us. And the evidence underneath it agrees. The recurring software revenue isn't breaking, installed base is still growing, and the timing gap on this cycle trough has a real explanation. I myself find IBM interesting at the right price, but not a business worth chasing on a 25% down day. My buy zone for the stock would be under $190 as I just showed you. But there are also 2 things that I would watch out for that could break this thesis. If transaction processing software revenue turns negative for 2 straight quarters, and I don't mean decelerate, I actually mean shrinks as in negative growth, we need to have a closer look at the recurring revenue argument. And if the delayed mainframe deals that should come within the next 6 months come in well below their estimations, the story of a timing anomaly would really turn into a demand problem story. If either of those 2 things happens, we need to revise the growth estimations and with it the buy price. In this case, the $190 would stop looking like a buy zone and start looking like a value trap. But until then, the math says that the crash told you more about the sentiment than the business. Now, what do you think about IBM? And do you find the current price an attractive entry point? Let me know down in the comments. And if you would like to know which market pattern has been 100% accurate for the last 60 years, why it might be breaking this year, and what it means for your investments, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.